297 to 301. The following scenario relates to question 297 to 301. On 1st April 13, P company acquired 75% of the 12 million 50 cents equity shares of S companies, Polster's S company. So we multiply. So they acquired 12 million of shares. Unit price is zero point 0.5. So the equity is of 6 million that they acquired. Because 12 million is the number of shares. Unit price is 50 cents. So the amount will be 6 million. P company made an immediate cash payment of 1.5 per share. Okay, so the number of shares is 12 million, and they paid 1.5 cents for this thing. So 18 million they paid as cash immediately. The statements of P&L for the year ended 30th September 13. Okay, sure. So this is mm, this is 30th September 13. So we will say 30th September 13. Okay. So on this date, P company's revenues is 110 million. S company's revenues is uh, 66 million. Revenue accrued evenly over the period. So I mean this 1st April 13 the acquisition happened and 30th September 13. This is the financial statements period end. So it is 6 months. Post acquisition period is 6 months only that we need to be careful about. Additional information. At the date of acquisition, the fair values of S company's assets were equal to the carrying amounts, with the exception of right of use property held under a lease agreement. Okay. This had a fair value of 2 million above the carrying value. So fair value is greater than carrying value by 2 million, and remaining lease term of 10 years. At that date, all depreciation is included in cost of sales. Okay. Second, contingent consideration was estimated to be 1.8 million at 1st April 13. At acquisition date, it was 1.8 million. At the period end date, it is estimated to be 1.5 million only. The contingent consideration has not been recorded by P company. Okay, so P company has not recorded it yet, and the directors expect the acquisition to be a bargain purchase. All right. Third, uh, P sold materials at their cost of 4 million to S company in June 13. S company processed all of those materials at an additional cost of 1.4, so they spent 1.4 million. Okay, total is 5.4, total cost is 5.4, and sold them back to P company for 9 million. So there is intercompany sale of 9 million, and then the P sold to S 4 million, and S sold to P 9 million, so it became 13 million. At 30th September 13, P company had 1.5 million of unsold inventories, 1.5 million, and there were no other intergroup sales. Okay. P's company's policy is to value the NCI at fair value, so NCI is recorded at fair value. Says company's share price is 1.2 million. The retained earning of S company's at acquisition date was 14.3. So these are all the information that we have. What is the ask? Question number 297. Question number 297. What are they asking? What was the fair value? Let me increase the font size so that it is visible enough. 297, they are asking fair value of S company's net assets at the acquisition date. Okay. So net assets, what we will take? We will take their equity. I mean, we should call it share capital. We will take the share premium, and there is this fair value adjustment as well. Hmm. Share capital, retained earning, and fair value. Uh, Retained earning and fair value adjustments actually. So their share capital is how much is their share capital. So it does, I mean, 6 million is their share capital, and then they have retained earning uh, of 14.3, because it is asking at the acquisition rate. Okay, so when we acquired them, it has 12 million shares of 50 cents each, so it has equity of 6 million that date. Okay, so we will take this 6 million, and then the retained earning at acquisition it is already provided, it is 14.3, and then there is fair value adjustment of how much, 2 million, so that also we need to consider. So this will be 22.3 million. Okay, uh, will be 22.3 million. This will be our answer. Okay, we'll take share capital, retained earning, and then fair value adjustments, because this that initially I wrote like share premium, but that premium is after the acquisition date, when it was acquired. But at that acquisition, the fair value of its assets was equal to their equity, which is share capital, retained earning, and then this fair value adjustment of 2 million. So this should be the answer. What do we have at 298? What are they asking? What is consolidated revenue for the year ended 30th September 13? So at period end it is asking, not at the consolidated. Not at the acquisition date. Consolidated revenue at period end. So at 30th September they are asking. So we will take P's revenue. We will take. Hmm. How much is P's revenue? It is 110 million. Okay. And then they have revenue of this thing S companies, that also will take. S companies revenue, this we will take, it will be 66 million. And what else, there is intercompany intergroup sales as well. Now there is intergroup sales, intergroup sales, how much it is, it is this 9 million plus 4 million. P sold to S, 4 million is sold back to P. So this we need to take out actually. So this will be a negative adjustment of this plus this minus this. Okay. It is how much it is? It is just 110, 66, and it is 13. Actually, this 66 million we can't take all, because it is for the full year, and the post acquisition is, you know a period is 6 months only, from 1st April to 30th September. So we need to be careful. We will take for 6 months only. So divide by 2. This 13 million will divide. So our answer will be 130 million. Okay. What are they asking at 298? 299 actually. Due to lower than expected profits of the acquired company. Yeah. So their contingent consideration fallen from 1.8 to 1.5 that they have given here. So for this, what will be the journal entry? So we'll reduce our liability, and the other leg will be our profit and loss. When our contingent consideration goes, so we will debit sorry, we will debit the contingent liability, and we will credit P&L. Okay. So they just, the option is liability only. So we will just say debit liability and credit P&L. Right? Against debit we will put this liability, and against credit we will put P&L. What are they asking at 300? What is the amount of adjustment to profit attributable to NCI in respect of unrealized profit? So how much is their unrealized profit? So they're asking like unrealized unrealized profit allocated to NCI. So their percentage is, we know their percentage is 25%, right? NCI share is 20 because 75% we have acquired. Okay. So first we will calculate the unrealized profit. Hmm? How much is the unrealized profit? So here we can see that they sold for, I mean, 5.4 million thing they sold at 9 million, you know. So maybe all of this information we can bring it back, or maybe we can do this thing here that they have this 9 million, they sold it at 9 million minus this 4 million minus this 1.4. So 3.6 million is the unrealized profit. Hmm. But how much it is still in inventory? That adjustment we need to do. Still in inventory. So how much it is still in inventory? So 9 million, we need to take a ratio. 1.5 million is there. Total was 99. Okay. So the ratio we can calculate here will be this 16 by 6%. So by this ratio we need to multiply this ratio will calculate, and then we will multiply it with this 3.6 million. So still in inventory, uh, this ratio, we will take this 1.5 million which is still inventory, we will divide it by the total amount of sales which is 9 million, we will get whatever we get, and then we'll multiply it by this 3.6 million of unrealized. So 600,000 is still in inventory, and because NCA percent is 25%, we will take 600 multiplied by 25%. Okay, so 150,000 will be our answer for this 300. Now this will be the adjustment to profit attributable to NCA, because adjustment, they're asking about the adjustment to unrealized profit allocated to NCA. So whatever we have allocated to them, now because the intergroup sale inventory that is still in inventory is 600,000, their share will be 25%, NCA share will be 25%. Okay. And then there is 301. P company measures the NCI in S company at fair value. Which of the following applies when non-controlling interest is measured at fair value? So in the question it is saying that NCI is measured at fair value, and then the ask is P company measures the NCI in S fair value. Which of the following applies? Okay. So when we value the NCI at fair value, which of this following applies? So first one is saying the NCI will be allocated to its share of any negative goodwill. No. NCI will be allocated the whole of the pre-acquisition profit. No, it doesn't. Hmm. The NCI will be allocated its share of any goodwill impairment, right? If there is any goodwill impairment, or any kind of loss for that matter, and this is also a loss, goodwill impairment. So their share, NCA share, will be allocated to them. So the third one will be the answer. The NCI will be allocated its share of any goodwill impairment. Okay, NCI will be allocated its share of goodwill impairment. Okay. So these are our answers: 22.3 million, 130 million, debit liability, credit P&L. The adjustment will be 150,000, and in this 301, third will be our answer. Okay. Third one will be our answer. All right. Cool.